dealt with leases, development costs, revenue recognition, and he basically put this book together. And this book was the Bible. I'll probably tell you, probably until the late 80s, he retired. A guy I worked with here in Miami, Nick Camerano, took the book over until he retired. And then he owns horses now or something. I saw him on the track the other day. So that book kind of went out of print. And then a partner at Deloitte wrote her own book, Maria Davis. As you can see, it's a lot bigger. And when Fred came, when Dr. Forgy came, he popped this book out of my desk and said, "Hey, do you want to use this book?" And I did use this book the first 2 times I taught this class, and it's a phenomenal book, but it's really a book for accountants. Okay, and it's a book for people who make their career as CFOs of real estate operating companies, real estate development firms, REITs, or are partners or manager level people dealing with real estate clients and public accounting firms. So it's probably more technical. It's called Accounting for Real Estate Transactions. It's probably more technical than what you need to know. So I've taken my lecture material from what I go from here, from the literature, from this, and then I'm also giving credit. This is the first time I don't require this. Up to now I've always required, this is a very simple, it's a continuing professional education class that the American Institute of CPAs puts together, and it's called Real Estate Accounting and Financial Reporting. I think, was it you, Jason?
The book you emailed us?
I
the
sent
book
you
you emailed us to read for next class? No, I'm asking because it looks like it's got the same picture on it.
I would email you something that I would not email you something that costs $200 and something that somebody's got intellectual rights to. I sent you something that's in the public domain, which is from the Financial Accounting Standards Board. Okay, so I think Jason asked. No, was this? You had a problem with the link. But I did put this in the syllabus. I believe it's if you read the syllabus, in the syllabus it says I'm not requiring this, but I am.
But the link is a little.
But I clicked on the PDF and the link worked. So, but anyway, so it is an accounting. It is a continuing professional education class. I've called the institute in the past. I've tried to get discounts for it. They won't give it to you, and they don't offer a book anymore. Now it's an online class. So I said, you know what? I'm not gonna force you guys to do this. But it's a simple sort of read on the basic issues surrounding revenue recognition, deferral of costs, accounting for leases in the real estate industry. So if your job is more financial, if you want to know a little bit more, it's actually a nice class to do. I think you get, I think it's 6 or 8 continuing professional education credits. I haven't done it in a while, but it's a nice source. I carry this. This is old. You see, I've carried this for a while. But you can get questions I always get for tax. I'm not a tax guy, so I use TurboTax. It's a great tool. So I'm not. Because I'm an accountant and because I am a CPA, I do have a little bit of a background in taxation, and I'll give you that, but taxation is a whole other specialty in and of itself. But the IRS makes things very easy for you guys. So you can get this online, or you can go to one of their offices and get it. Some of these things sometimes are out in post offices, okay? Tax guide for individuals. There's a tax guide for corporations, okay? Anything you need to know, anytime I've got a tax question, I got some in TurboTax and I don't get it, I go to the IRS site. The IRS site is very, very helpful, very easy to read. It tells you every form you need to fill for everything, okay, and it tells you how to do it. So if you ever got a tax question, go do the research. Don't go to Google, okay? Now, if you go to Google, if you got a tax question, you go to Google. If you got a real estate tax question, you go to Google. At times you will find good information. We'll go, because 1031s come up a lot, we'll talk about 1031s in detail here. There are some law firms that have some very good guides out in the marketplace on what you need to do for 1031s. But there's also junk out there because people trying to sell you products. Okay, so you just have to be very careful. But if you really want to know the rules on 1031, there's a nice little sort of PDF that the IRS has that tells you what you need to meet. So I would just encourage you to do that. I spec'd this book out 3 or 4 years ago, and I decided not to use it. Principles of Real Estate Accounting and Taxation by Joel Rosenfeld. He is a professor at NYU. It's a tax class. So if you're interested in taxation, principles of real estate accounting and taxation, but it's really, you see, taxation, Joel Rosenfeld, okay? It's an e-book. I printed it, but I don't really use any of the material from here because it really would focus the class in a radically different fashion.
Joel what?
Rosenfeld. Principles of real estate accounting and taxation. Abbreviations. Listen, I want to go through some of these that I think, you know, are going to jump at you, okay? But, so, we use these all the time. We use these in a program. Some of them for you may be easy, some may not be. GAAP. What's GAAP? So when you're in London, that's what you have to mind between the train and the platform, right? The GAAP, right? What is GAAP? Generally accepted accounting principles. Now, from that perspective, we'll talk about that. There are U.S. generally accepted accounting principles, but if you're in the UK, you don't follow U.S. GAAP. Okay, so GAAP may mean something in this country, it may mean something in another country. We'll talk about that in this term. Okay. What is FFO? What is FFO?
Funds from operations.
What is funds from operation? So FFO is like, I would say FFO is like what? Like what term does Dr. Forgy use in his classes all the time? It's kind of like NOI, right? So it's like a measure of cash flow, right? So if we think it's like NOI, what would in a typical income statement FFO look like? Funds from operations, what would it look like?
Liability?
No revenue.
No, liabilities are a balance sheet. We'll talk about the difference between a balance sheet and an income statement in a second.
Net revenue.
Well, so it's some sort of measure of revenue or income, right? So I would basically say that the easiest way to say it would be net income, and you add back depreciation, right? That's probably, you know, kind of easiest way to take a look at that. Or maybe because, just to clarify, because in REITs, we don't have corporate taxation per se, we could kind of call it, right, EBT, earnings before taxes, right? And we add back depreciation, right? Or maybe more correctly, EBIT, earnings before interest and taxes, and add back depreciation, okay? So it's a measure of cash flow. Now, there is another nuance. Put the phone away, please. I thought you were going to turn it off.
It wasn't.
It was off. How did it come on?
Oh, I never like fully turned it off.
So, were you Googling the answer? Since you were Googling the answer, what else is missing in FFO here? You're not paying attention.
You lost.
Mea culpa, mea maxima culpa. Okay, so, you know what that means? Zero for participation. And she went back and picked it up again?
Well, I wasn't finished.
Can you wait 15 minutes?
Yeah, I can.
Plus or minus what? No. What else might be, what other item might be in here, an income? What other item might be an income that isn't operating in nature?
Gains?
Gains and sales from sales of property. So plus or minus gains or losses, right, from sales of assets. So ultimate, we're trying to, so FFO is kind of a public company, a REE proxy for what we would call NOI in a private real estate venture. Okay, we're trying to get a handle on what operating income is. Okay, what cash flow from operations are. Now, why is this important? Ultimately, people want to know, right? And you're going to see that. We're going to spend a fair bit of time going through this. Okay, people are going to see in a regular public company environment, people talk about earnings per share. How much income did my share make? We'll go through that in detail, okay? You don't have to memorize this right now. But in a REIT realm, people are going to look at what were my funds from operations. So people are selling you a different concept. What's my NOI per share, if you may, okay? So just understand that in real estate, people may not use the same terminology for financial statements that they do. So start getting used to these. Now, jumping ahead, there is something called AFFO. Adjusted funds from operations. So that's a little bit more complex. And what do you think AFFO is? It's one of the,
Adjusted for inflation.
Adjusted after tax.
we,
I'm pulling up the chart, so I know what you're talking
oh, you didn't read them?
about. I did, I just.
Oh,
never-
okay, I just thought, okay. So, I mean, because it says it right here, we don't have to go that far. If you've got it in front of you, it's one of the definitions, right? So we said REITs, and we'll talk about REITs. What's a REIT? We've talked about REITs, most of you have been in this program.
Investment trust.
Okay, so a real estate investment, and by the way, jumping ahead, NAREIT then would be what? The National Association of Real Estate Investment Trusts, okay? So, but a REIT is a real estate investment trust. What is a real estate investment trust? You've covered this. It's in the Brueggemann book. You don't, they don't look, no, they don't look at, okay.
So it has to disperse 90%.
Okay, so a REIT, okay, so let's, because this is important. This is important, okay, this is important. Because when we talk about the real estate quadrant, right? And by the way, those of you taking the capital markets class, you should know what REITs are, right? So when we talk about the real estate quadrant, and we talk about how you can participate in real estate, right, capital, and we talk about you can real estate and participate in public debt, or private equity, or public equity. When we're talking about the public equity quadrant, and we own real estate through a publicly traded vehicle, right? That publicly traded vehicle typically is a REIT. Okay, now, there are other forms of publicly traded real estate companies. There are very few, but there are some REOCs out there, real estate operating companies. But for the most part, the public ownership of real estate is through REITs. Now, REITs are, it's either, oh, look at my notes, I'll get it. Either Section 856 or 65. Okay, I'm dyslexic today. Of the Internal Revenue Code. All right, so a REIT is an election for tax purposes that a company makes. What a REIT gets, the benefit that this election, this IRS election gives you is the ability to avoid corporate taxation. Okay, so eliminate the double taxation of earnings as long as you meet a series of criteria. The most common one of which is if a REIT distributes 90% of its net income to its shareholders, it bypasses corporate taxation. So, said a different way, a typical company would have sales, let's just say selling, G&A, whatever, all the expensive cost of goods sold, depreciation, interest, look, you get to an earnings before taxes, right, number. Then we pay taxes, so now everybody has to pay taxes. And then you get to net income, right? That's what a typical company would do. A REIT does not pay taxes. And just, so what that does is in this company, we have what's called double taxation. Typically, a corporation pays income tax, and then when it distributes its dividends to its shareholders, the shareholders on a personal level pay taxes on the dividends. So what this REIT election is, it eliminates the double taxation by eliminating the corporate level tax, but then the individuals pay the tax on the dividends that are distributed to them. Noah, you had a question.
So is that why the yields are so skewed over the 5-year when you compare them? Because some years they'll disperse more and then reinvest to offset the loss.
Well, so there's a couple of topics that I think are important as it relates to this, and I'm going to try not to lose people. The first thing is I'm not sure how REITs trade now. I've tried to figure out how REITs trade. Most companies trade from a valuation perspective. Can we speak at lunch, please? Thank you. We're going to speak, most companies trade on a valuation basis based on a multiple of earnings. And most industries are going to have some sort of baseline, right? So some companies may trade typically at 10 to 12 times earnings. Some are going to trade at 8 times earnings. Some trade at 25 times earnings. There are different features, and we can talk about this stuff. Value companies are going to trade at lower PEs. growth companies are going to trade at higher PEs, price earnings ratios. We'll talk about what price earnings ratios are. REITs don't trade on multiples of earnings. First of all, REITs, while they have an earnings per share number, people don't focus on the earnings per share, people focus on the FFO. But REITs, to some extent, historically have traded kind of as yield instruments, okay? And so there's been a perception of what a current return should be, and management tries to maintain that yield at some sort of market expectation, okay? Now, my arguments were lately, REITs are trading kind of like bonds. You know, all of a sudden the other day, the Fed said, hey, we might have raise interest rates in June, and all of a sudden, like the 4 or 5 REITs that I have, I mean, went down like 12, 13% in a day. In a day. And we talked in the capital markets class, there's this, remember this article that Dr. Wu at FIU wrote about this whole inflation illusion and what happens when there's the specter of rising interest rates and how that affects valuation of stocks and of REITs, okay? So, but to your point is, there's been this expectation, but the reality is the REIT has the obligation to distribute 90% of its net incomes. Now, there may be some wiggle room. Do you distribute 95%? Do you distribute 110%? But the real issue that you have is for a REIT to grow, what does a REIT need? What does a company need in order to grow? Where does it get its money from? It doesn't get money from investments. It needs money to make investments, right? So
And the shareholders
look, I don't want to.
I want back more than 90% because then they're taxed.
Well, no. Forget the taxation for a second. But listen. And I don't want to jump ahead because I cover this later on, okay? But when a company generates earnings, it can do 2 things with them. A company can retain them and reinvest them, or it can distribute them. Okay? So typically we talk about something called retention ratio. What percentage, right, of a company's earnings does it keep to reinvest for the future? Now, if you're a shareholder, what do you want?
Dividends.
Dividends, right? If you're management, what do you want?
And earnings.
Well, you should, right? And that's, again, you know, we're talking about different pressures that exist here, right? Shareholders want the money. Management, in theory, should want to keep money to reinvest. And a measure of shareholders' measure of management is can I get a better return by retaining the money there and having management reinvest it? Or do you give it to me because I can reinvest it at a higher rate of return, right? And today we get into all these issues of, you know, management buybacks of stock. Company buybacks of stock are at all-time highs because management is saying is we really cannot invest in anything other than our stock, distributing it to the shareholders, diluting or anti-dilution or reverse dilution of shareholdings, right? We can't find investments that yield a higher return than this, okay? But going back, so for a company to grow, it needs to have a higher retention ratio, okay? In fact, in finance, if I'm not mistaken, growth is sort of equivalent to retention ratio or a function of retention ratio. Because in theory, a company should be able to grow by reinvesting what it retains, okay? Now, a typical value established cash cow company in this country, Exxon, Dow, DuPont, what do you think their retention ratio is? How much of their earnings do they retain? Any idea? Try a door number 1.
5%.
No, they're stable, they're cash cows, they're not really, so, I don't know, let's use 50%. You know, probably somewhere between 40 to 60% is the typical retention ratio for an established company in this country. Now, what happens all of a sudden you're a REE and you're only retaining 10%? How do you grow? How do you grow? You have no capital to grow.
You get more people to invest
So what happens is, and that's exactly the point, and I think we've talked about this in the capital markets class, is REITs are one of the few industries that the market does not really penalize for subsequent or secondary issuances of stock. And so REITs are continually going back to the capital markets to raise equity. So there are always reissuances or additional issuances of equity, because otherwise a REIT can't grow because they're distributing all their money. Okay? Now, one of the things you need to be careful with is, going back to the yield comment, is many REITs, so you have a requirement to distribute no less than 90% of net income, but you don't have a restriction on how much you can distribute. And so a lot of times, people are targeting, hey, all multifamily REITs today are distributing 4.5%, yield. That's kind of where they're trading at, okay? And in some cases, that may be just right there at that threshold, but some companies may be distributing 200% of their net income. How long can you distribute double what you make? Not long, right? Not long. All right, so these are things we're going to be, talking about in this class, learning relationships so we can analyze and understand, and we can ultimately make decisions on, for ourselves and for our companies that we're managing, okay? So going back to the comment, so AFFO, there are two other things that, so AFFO is FFO, right? Plus, and we do two things, we got to add back recurring CapEx. Okay, so to the extent that we're making continual, sort of CapEx in the business, and we deal with the effect of straight line rents. And we'll talk about straight line rents, we'll talk about leases next term. I don't want,
What's the number one?
recurring capital expenditures. Okay? So again, but ultimately, it is another measure of cash flow. Now, curiously, I recently saw one of these supplemental reports that somebody had adjusted, they used a term like normalized AFFO, or readjusted AFFO, but it was like another measure. So, but ultimately, companies are trying to give shareholders a view of what cash flow coming from operations are. Okay. Let's go through a couple of these, and then we'll. So, bargain purchase option. We'll talk about that next class. That's when you have a lease, right? At the end of the lease, what can you do for $1? For $1, you can buy it, right? What's CAM? We know what's CAM. It's a short name for Cameron. Common area maintenance. And common area maintenance is what? Well, so they are expenses that are for the benefit of all, and then shared by all. And how are they shared?
On a pro rata basis?
Typically pro rata, right? Typically pro rata, right? So, if you occupy X%, you typically would pay your pro rata share. Okay? Joint ventures. What's a joint venture?
Coalition between two entities or people or
So
companies.
legally, a joint venture is a partnership.
Right.
Okay? And we typically talk about, a lot of times, I would say by default, joint ventures, sort of by default, well, they don't have to be. Typically, it would be 50-50, right? Okay? And we tend to see a lot of joint ventures in real estate, right? Because certain people bring capital, certain people bring deals, right? Okay?
A joint venture doesn't have to be two parties.
No, it could be the same.
It does not have to be two parties. No partnership has to be two parties. There
No,
has
that's only 50-50 there, so.
there have to be more than one.
Yeah.
Okay, there have to be more than one. Down REITs and up REITs, I'm not going to spend time. Down REITs and up REITs are just different legal structures of REITs, okay? It's the way that the units, the ownership of the REITs are. What is eminent domain?
The government taking property for the public good. Public use.
Yeah,
Accommodation.
No, that's the process.
so it's when a governmental unit, takes over land or condemns land for public use. Now, does it have to be a governmental unit? Is eminent domain? Okay, so we're starting to see now that there may be private initiatives that also have an ability and I guess that's an evolving, I don't know, it's kind of an evolving area.
Do you have an example of that?
Like a economic development district.
I'll give you what hypothetical would be. Think of a stadium, for example, that maybe a public-private partnership where maybe the part of, an adjacent parcel or something would be condemned because that's the only way that the developer can put together the deal in order for the stadium to happen.
Perfect
But this is,
example, New River.
sorry?
New River, because Mary Brickell had it, and then the city said, we need this because you're obstructing the waterways and flow of traffic through the navigable waters. So they gave her fair market value, and they took it.
Yeah, but that was
that's
initiated
not
by,
private.
that was initiated by the
Private,
public
public.
sector.
I thought you.
Yeah, so
My question was more
So
like.
what I'm saying is this is an evolving area where people are pushing the legal envelope right now. And it typically would have to be a public-private, venture, okay?
The public entity is the only one that can do it.
There's gotta be.
Well, no, there are people that are pushing and it's.
Railroads are a good example of a private sector
There we
entity.
go.
Cemeteries are another example of a private sector entity that have limited powers of eminent domain, as do a lot of economic development districts.
Yeah.
Oh, Hudson Yards. They're building a tunnel just for government use above the railroads. It cost them like $267 million for the tunnel.
Yeah.
That's a related project.
Yeah.
Okay, we're gonna, all these sort of lease terms and revenue terms, we're gonna go in greater detail when we have that. What's a lease? What's a lease?
A contract to use space.
Used for a specified period of time.
Okay, so a lease is a contract to use,
To occupy.
Space, real estate.
to use an asset. In the context of this program, it may be real estate. And we can define real estate in a different way, but it's a contract, and it grants the right to use an asset, right? To who? Who gets the, who's granting and who's being
The lessor
granted?
and the leasing.
Okay, who is the lessor?
Person that's leasing.
The one who's leasing, what do you can't define, you can't be circular. Who grants the rights to use? The lessor, not the owner, the lessor. The lessor. Who receives the rights? The lessee. Okay, is that the same language like when we have is a mortgagor like a lessor?
No.
No, it's backwards the other way, okay? It's the reverse, okay. But a lessor grants rights and a lessee pays for rights, okay? So, to use an asset, in this context, real estate in this program, for a definite period of time, okay? So, all contracts need to have a stipulated, they could be 99 years, okay? What is a like-kind exchange?
Like kind of exchange.
Yeah.
Barter.
No, barter is,
Similar asset to another asset.
yeah, so, okay, so
Exchanging properties for 1031.
exchanging properties for 1031.
And exchange of real property for other property that meets criteria of 1031. That's what the
That's what I like.
Okay, well, so,
like kind of shit.
okay, so more broadly, now we can hone in on 1031, so more broadly, owners of corporate assets or individual assets may exchange, not just barter, okay? So I can exchange, I could put a value on this and say, hey, I'll switch it for yours, right? We can just, or we can have boot associated with it, right? We say, hey, this is worth 1,000, that's worth 1,200, so I'm gonna give you this plus $200, and then you're gonna give me that, okay? Now, in the context of real estate, what the country, we'll go into detail on section 1031. So what we have an ability to do is to exchange or sell. So we could sell real estate and then with the proceeds buy real estate and assume that it's an exchange. We've not sold and bought, but we've exchanged one asset for another under some advantageous tax advantages if we follow the guidelines of section
Pretty much the same.
1031. What?
So it's pretty much the same thing minus the timelines for
No, so
for
this,
acquiring and
no,
for
but hold on.
the term.
All I was trying to say, Noah, is that a like-kind exchange has a meaning in and of itself, independent of tax treatment for it. So you can do a like-kind exchange without real estate assets and without the real estate tax advantage. Okay, so corporations may exchange assets, all right? You may have a like-kind exchange of assets, which, as we know in real estate, like doesn't necessarily mean like, right? So like could be I swap a computer for a computer, but in the context of real estate, I could sell land and buy an apartment building, and the law would construe that as like. But all I was trying to highlight was the fact that like-kind exchange has life independent of the tax treatment related to it, okay? Monetary assets and liabilities. We'll talk a little bit about, so what do you think we mean by monetary assets and monetary?
Cash in your house.
Well, so monetizable. Ultimately, in accounting, although we don't really do this in real estate accounting, we classify balance sheets. We classify our assets and liabilities. And what I mean by classify is we try to distinguish between what we call current and what we call, long term, right? And typically what we're trying to get to is a measure of how monetizable an asset are. So, for example, cash, what is it? Money talks and cash screams. Like cash is very monetizable, right? It's cash, right? A building is not as easily monetizable. What about accounts receivable? Probably more monetizable, right? Inventory, probably more monetizable, right? Because presumably we could sell it, right? A refinery, probably not monetized. So what we try to structure is our balance sheet in a way so our readers can see how monetizable or how liquid or how able is a company to meet its obligations, right? And then we'll get into some analysis of this, but we try to break down assets between their sort of moneyness, right? How can we convert it? How convertible are they to something liquid? Yes, Emmanuel?
How do you justify accounts receivable?
When you say justify, I mean, do you want me to justify to the right or to the left? I mean, I don't know. Yeah, it's not. What do you mean by justify?
Well, let's say you have a contract for $200,000 and you've only billed for $10,000. Can $200,000 be considered accounts receivable or $10,000?
Okay, so you're a construction company. Okay, and so we'll talk a little bit more about construction company accounting later on. I'm not going to spend a lot of time on that, but construction companies essentially recognize revenue on what's called a percentage of completion method, and it's typically a percentage of cost incurred to total expected costs. So every period you're adjusting your total expected costs, and you're going to recognize the portion of your profit, right, of what you've incurred to date over the total anticipation. So if you've incurred 50% of the expected costs, you should, under construction company accounting, be able to recognize 50% of your profit. Does that make sense?
All right. Now, in a real estate context, I sign a 5-year lease. Can I recognize the 5 years accounts receivable?
Okay, so one of the sort of basic, going back to the question that I asked earlier, right? One of the basic tenets of revenue recognition in accounting is if we delivered the good or service that we've contracted to do. So let's think of this scenario, right? I'm a lessor and I lease this office to you for 5 years. Have I provided all the goods and services that my contract calls for?
No.
How would you typically use them? I mean, theoretically, you're realizing those benefits every day, right?
Right.
But pragmatically, in accounting, we would recognize revenue for leases on a monthly basis. Okay? And in this country, we typically pay leases when? In advance. And we pay mortgages typically? In arrears. Okay, now, doesn't have to be that way, but that's kind of my business practice, the way things are, okay? So typically, most real estate operators would collect and recognize income at the beginning of a month, okay? Now, because we report at the end of the month, we'll also incur all of the expenses during that month, and so we should be able to matching principle, we should be able to match our revenues with our expenses, okay, on a periodic basis.
So it will be monthly accounts receivable or?
Right, so typically we would recognize income monthly. Now, I don't want to get into real estate property management, but I'm telling you this, if rents in this country are collectible typically in advance, at the end of a month, you better not have collections outstanding. You better not have accounts receivable, and if you do, as a real estate management business, you're not doing a good job in collecting. Because as real estate operators, we're not in the business of financing our clients' working capital. We finance the real estate, so we expect that payment up front. So if you've got collections outstanding, if you've got receivables, and you're a real estate owner, probably not good.
Liability.
No, liability means something else. We'll talk about that after you eat, okay? Let me just go through a couple of other quick things and we'll break for lunch, okay?
President, a question.
Yes, sir.
What differentiates between current assets and long-term assets? Is it the time frame between assets?
So the definition would be typically what is defined as a current asset or a current liability is an asset or a liability that is expected to be realized within the current period, which for most businesses is typically 12 months. So typically, any asset that could be converted or expected to be converted to cash in a 12-month period would be recognized as current. For example, I would expect to collect my receivables in less than a year. So receivables, I would expect to sell my inventory. Inventory would be recognized. If I prepay expenses, I pay insurance at the beginning of the year, but it's the premium for the whole year. I would consider that a prepaid expense, but because I'm going to realize that benefit over the year, that prepayment would also be a current asset, okay? Deposits that I would make that I would expect to realize or convert on would be considered current assets. Anything that's not current by default is long-term.
Like a car payment and stuff like that would be long term?
Well, so a car payment is... So the answer is no. The answer is no, but I don't want to just leave it at that. Let's get into the accounting primer in the afternoon, and we'll get into what assets, liabilities, and equity are, and we'll cover that. Okay. Look, here's what I'm going to do. To spare reading all of this, I expect you to read these and know them. And you need to know them for this class. And you need to know them for this class. And you need to know them for this program. And you need to know them for your careers. So listen, it's 12:30. Why don't we reconvene at 1 o'clock? Okay, your lunch is back here. Ready to head now?
Yep.
I ordered a bunch of extra ones, so if you just want to grab
Alright.
one of them, or you can go back up there.
Alright. Is there just not a name on the ones that you grabbed?
They're the extra ones. I think were mostly just 12 to 19.
Okay.
But I actually got that
Anybody know what HTC means?
We actually got our questions on that.
You actually got it, you're like me, I'll do it.
What I wanted to ask is
So we go.
But they're all
Blurring, not so clear.
You can see this thing going down.
Yeah, well,
yeah, I did.
okay.
I like stuff.
I was looking at this.
No, but I'm going finances before it's making it, I don't know how you guys.
No, sorry, I was looking at this, the master.
I know what it is.
Right here?
It wasn't the same.
Shower.
And
This is the 19-inch
Yeah.
Right. No, I was looking at
Finance, they'll do okay, because
I saw the line when I went out there. I went out and saw the hard lines.
But he said he did order a lot.
Yeah.
What's HCC? Right. But barely at all. I think he learns how to use the calculator.
I'm hoping. What's the HCC?
So hungry right now.
Ham, turkey, and what's turkey? I'm like, I don't know what to say.
Erica and I
Ham,
were
turkey, what's the
planning-
season? Because turkey, okay, got it.
I have the same.
And you know that's next year, I might put that. We have to do a cross.
Oh my god, that's like way more.
No, I'm taking it now. Let's go eat over there right here.
I want to. I don't want to stay.
But it's tough in the second master, we're gonna add that.
Kathy gonna eat?
Trust me, that's why I saw it on Tuesday. I'm like, I got
So we might as well restructure it then.
Let's go.
Yeah, I have to take that first test. I thought you
Yeah, she's over there.
My buddy said, he's coming Monday. And I'm looking at doing an equity partnership. The 13th.
Did you get Greg did it right there. Oh, maybe this guy right here.
And eventually,
So, and
when
at that
it's
point, I was
5
like,
more
whatever,
years
just
old,
email me.
tear it down.
No, that second one, I like halfway through.
It's gonna be a couple million bucks.
Well, the first one I didn't finish. I was just like, I was not able to finish it.
I think for the your
Well, there's tenants
I'm
there.
looking over my notes, but like, isn't.
We were either thinking about the tenants extending the leases, putting it as an asset, performing asset.
I would send them the cost to develop the plan and then see the feasibility. If anything, you can make the plan in place.
In the modules that we have as a printout,
Try to sell it as a table.
all the example problems they give you are exactly for the purpose.
It's a thought we had, but we're also working on.
Yeah, remember he sent us something like 3 and 4 cash flows and something.
He said no.
Look from his first email.
I said, he goes, how about you just buy us out
Totally
and class me?
clearing, because I
Does-
trust me, before you send them I don't even like this one from like May 4th, and then he sent another email with the
Creates employment cases.
I don't know if I can save that.
Sal, what's up, man?
Yes, I mean, if you ever get what's
Hey, I need to pay you.
At the end of it, yeah, but if you give me your
Yeah, if you want your money.
there are a few of the answer pages missing. I
Oh no, to like answer you need to take the quiz.
please.
Oh no,
Actually, I
that
know that it
he just sent the email with the quiz.
That's fine. Hold on one second.
Alright, so you're reading the articles, it's fine.
Okay.
The quiz is the link that he just sent
You guys?
2 days ago, whatever.
Isn't that crazy? Your Nova one pop
Yeah,
up.
so you have that.
I'm in baby grade.
It's okay. I get it. Do the
I'll catch you check. And
So I have that.
Yeah.
Now, he's whatever he
The
said.
quiz, yeah.
But I don't know about the article. That he said, now the article's on there.
In the link, you can, in the email that says the date.
Okay, that one has the missing pages,
Right,
and he also helped me with that one.
So on
Okay, so,
I know, but I didn't even think that class.
the information,
So I can
I'll bust you check.
Okay, I literally, like the whole back section It says like sample whatever. I literally made copies of that. I try to do 5 different copies. So by the time I get to the one, I'm like, okay.
I'm ready to report this for the first time.
No.
And learn vaguely something, like a vague concept, idea, and then get very specific questions.
And I might have something else to come from.
And then you're trying to very quickly put everything
The email that you just sent out to me,
person,
or
or
to
me,
me,
or
it says
reader, writer.
Yeah, I walked them through, explained everything.
that tells you
I said, listen,
the story.
you can have a say so, I'll give you a couple of options. You know, I'm not gonna let you just choose whatever, but I'll give you a couple of options that would be neutral.
It wasn't from him, it was
You
from
select which one you want, and
it
we'll
was
put it
from,
together.
did you register the
Oh, that's
test?
smart too.
And he's like, well, I meant one security system. I don't care.
I only have 2 minutes. Hold on.
Don't you think that that's
Really helping because
It
like,
says-
and then we're not gonna use those for the test, right?
No.
I had it budgeted, I figured it'd be
If you really
seawall repairs, pilings, anything else.
Maybe I where it says click
And then,
is it the same?
In my head, I was thinking it could be up to 20 grand.
but imagine it would be 3 quizzes, and then if you
But like
do
mine
the
is
test,
saying-
then you would stay
That's
on
what
the
my head
test.
was saying.
So by the time
Mine
you
is saying
oh,
register
okay.
bad.
You do.
You see, I never
Oh my
received.
I'm gonna just do a 70-foot
So I
dock,
was looking,
make
I
it
think
nice,
he's just
clean,
doing.
simple.
But when you start, you
Put some
rest
power
out
and water.
Yeah, I just, so.
Fish cleaning station.
Well, thank you for that. You're welcome. Hold on.
Did you have to raise capital for Florida East Coast?
We did not, well, at Florida East Coast Industries, we didn't, well, I mean, listen, we own the railroad. We own the railroad that was a cash cow. I mean, we had CapEx related to the railroad, but the railroad provided most of the equity that we need for real estate developments. Now, we would sporadically lever the,
I think he said he ordered
yeah, so we had to raise capital, but it was debt, and we do it on an avenue.
I don't know what it means, but I just worked a bunch of those. Club.
Going out to me, we're always going out there looking for equity.
Are we on Thursday? It's baseball at 11?
Where?
There's a rooftop there.
What?
Baseball at 11? Downtown. Restaurant.
I'm like,
Everybody wants sponsorship, a promoter has skin in the game. If you don't have skin in the game, nobody will do business. Now, when you go out and get the bulk of the equity from somebody else,
I have a couple.
somebody's wanna see whoever's promoting you, should have something in it. You understand what I'm saying? Yeah, so, that's gonna want equity before it plays. But equity's gonna want the sponsor to have equity before it plays. That's exactly what I.
right, I mean, SBA.
No.
But sometimes.
And madam. Because I just have it's impeachment. Yeah, it's impeachment or death by fire. Which one would you prefer?
I'm hearing it. That's what they're.
What?
I mean, I
What is that?
read the
Like, I'm sorry.
Hostile takeover.
What?
No.
Hostile takeover?
No, you gotta send me.
We don't want to take you guys over. Seriously, right?
what I'm just gonna do is, I'm gonna cut and paste. So I have myself seated there, so.
Not Wynwood, but like, oh yeah, Wynwood and down.
Come on, this out.
Yeah.
Probably the 1.20.
The land.
$100 million for the rate.
Oh yeah, what is that, Marina,
Yeah, there's like a beginning of like,
you see what they're doing in, Bahia Mar?
We tried to, working out 3 or 4 deals.
My sister.
so anyway, from
AC 45, like the hot box.
even on a commercial standpoint.
It's actually really cool what they're doing there.
I'm not sure how to value it on the commercial side, but we do it all pretty good.
Because I feel like what they should be more
Your MP 2187?
Now I'm.
Oh, like where the job is like tomorrow. Oh, yeah.
I'm a Floridian. Now I'm a Floridian.
You are Maria P.
And that's such a road.
Okay, I'm just gonna forward you the
Where are you from? I live in Brickell.
email.
I'm a yardie.
He was born and raised in Brixton.
I'm from there, just ready.
Never heard that? Born in Jamaica, but.
In the previous class, he was like, I have a cousin in Brixton. I was like, wow, we did not know.
You were born where? Jamaica.
Jamaica, Street of Brickell.
Collecting interest on the property for the state back.
Well,
For the condo,
You realize that you don't have to read, you realize that you don't have to read all of that? I mean, in like great detail, you'll
all
realize
I'm
that.
trying to say, it is a revenue stream, a net revenue stream, not gross.
No, I just wrote up my
Unless you're the county, then you don't have.
But the good news is, there's no other reading assignments up about, I don't
They do
think.
that in auction.
I'm trying to figure out the
read the textbook.
When is that?
What's next, Bob?
I agree, net revenue stream, not gross.